For detailed explanations of the account types and how to use them, you should watch the sample savings and sample retirement plans first. Please note that some screenshots may vary depending on which Financial Mappers product you are using. If you are using Financial Mappers Pro or Financial Mappers Lite, then the company who provided access to the software will set the default rates. The default rates in this example are the 20-year average from the year 2000. First, the current financial information must be entered in the starting position. It is really important that you select the option Joint. If you do not, you will not be able to nominate the owner of the assets. Mary plans to work 2 years longer than John, as she is age 58 and John is age 60. For the budget, just one annual amount has been entered. It is strongly recommended that you create a full detailed budget of your living expenses. The transaction account, which acts as a checking account for investments, home ownership and superannuation, is always a joint account. The home and the emergency cash accounts are also joint accounts. John has investments in shares and Mary has investments in managed funds. In superannuation, each have their own account. If they had a self-managed superannuation account, then they could have a joint account, but the information would need to be entered directly into the plan. In the last section, it is essential that the amount of savings from salary is entered. The program will add this money and any additional loan payment allocation to the net cost of home and investment loans. This dollar value is then converted to a percentage of gross salary. That percentage is allocated in the plan to salaries of both partners. This can be adjusted later in the plan. You could generate a report showing your current financial situation. Note how the ownership of the accounts is allocated. Now the plan is created by importing the starting position information. In the plan details, the plan name must be entered and the plan type. This plan type is called a lifetime plan as it is a combined savings and retirement plan. Because the starting position was for a joint plan, this option is automatically selected. You must enter for both partners the age at the start of the plan and the age at the start of their retirement. The plan will commence the retirement phase in the year of retirement for the first person to retire. In this case it is John. Mary will retire 2 years later. You can also enter the target retirement income. This value is only used in the calculation of statistics and will not affect the plan. On the objectives chevron, you can enter the plan objectives, plan strategies, general comments, and any milestones. The information for salary and percentage saved has automatically been imported. We will quickly look at each account, and where the entries are different from the default entries, these will be highlighted. The home is jointly owned. The emergency cash account is jointly owned, and there are no plans to draw down the funds in retirement. John's shares have 60% imputation credits and will be drawn down over 25 years. Mary's managed funds have no imputation credits. Note that her drawdown will not commence until year 3 when she commences retirement. John and Mary have set up a savings plan in lifestyle goals. They plan to save for a car replacement every 5 years and have an overseas holiday every 2nd year. In the investment plan, John and Mary intend to make personal pre-tax contributions to their superannuation, so these accounts must be ticked. The program automatically assigns the cost of the loan, which will be repaid in 5 years. The balance of the funds will be allocated for the first 5 years according to percentage. Any funds not allocated are paid to the transaction account together with the cost of loans. In the first 2 years of the retirement plan, Mary continues to work, but all the funds have been allocated to the transaction account. John's superannuation will remain as a balanced fund which will be drawn down over 25 years from age 65. Mary's superannuation is also a balanced fund, and her drawdown will commence when she reaches age 65, which is year 3 of the retirement phase. it is now time to create the retirement income plan. As Mary is working for the first 2 years, the amount required is less. Note the graph which identifies if the transaction account has sufficient funds to pay the nominated drawdown amounts. Looking at the present value graphs, the value is divided into funds withdrawn from retirement accounts, investment income, and investment capital. The drawdown funding displays from which accounts the retirement income is withdrawn. The net investments and retirement fund graph displays the total funds available. The last graph would display any pensions from external sources. These values are not part of the retirement income and are paid directly to the budget. If you activate the means-tested pension, then this will automatically be calculated and assigned when they are entitled to pension payments. Finally, let's take a look at the transaction account. In the retirement phase, the drawdown amounts from the various accounts are displayed as deposits at the start of the year. The retirement drawdown is displayed as a withdrawal at the start of the year. This money is transferred to the budget. In the savings phase of the budget, the salaries are entered as the only income. Tax paid on the personal income and savings allocated from the salary are displayed. In the retirement phase, Mary's salary for the first 2 years is displayed together with income from the retirement plan. Note how this is allocated as drawdown from retirement accounts, investment income and investment capital. Let us have a quick look at the other chevrons. The financial targets have been entered. On the review page, you can move the slider to see the results for any year of the plan, and you can click on the information icon to access more information. The key indicator graphs are designed to alert you to any important information you may have forgotten. Have you allocated all salaries and savings from salary? Have you allocated the salary savings to the accounts intended? Are the loan costs greater than the savings, in which case the column would be red and extend above the total savings line? Do you have sufficient funds in the transaction account? If the account is overdrawn, then you must return to the plan and adjust. Have you allocated from which accounts you are withdrawing funds? Did you forget to activate one, say the superannuation account? Finally, your investment target graphs will display the results. On the report chevron, you have 3 sets of reports. Note that for the insurance needs evaluation and the tax estimator, there are separate reports for each partner. The plan outcomes will give you a detailed view of the total plan in both present and future value. If you are using Financial Mappers Pro or Financial Mappers Lite, you will have a 4th panel of reports created by the company providing access to the software. You will also have an extra chevron called Plan Review, where these reports can be uploaded and viewed one section at a time. Finally, you can access the modelling tools to consider any what-if scenarios. For more details, you should read the PDF in the sample plan.